Welcome, everyone. I am literally so thrilled to have you here today for this explainer. So, we're going to be breaking down Vale's absolute monster of a first quarter earnings report for 2026. Now, if you've been following the commodity space, you know these earnings reports can sometimes be, well, a bit dense, overwhelming, and honestly kind of dry. But not today. We're going to take all this data and transform it into a super clear narrative so you can see exactly how Vale delivered such a robust start to the year. We've got production records, some really surprising cost dynamics, and honestly, some truly massive capital allocation moves to cover. Let's get right into it. Okay, let's dive right into our roadmap for today. We'll start with 1, Vale's Q1 financial snapshot, then look at 2, the iron ore engine, and 3, the base metals boom. After that, we'll hit 4, cash flow and debt, 5, rewarding the shareholders, and finally wrap up with 6, ESG and looking forward. Section 1, Vale's Q1 financial snapshot. Vale's strong start. Let's anchor ourselves right away with this massive number, $3.895 billion. That is Vale's pro forma EBITDA for the first quarter of 2026. To put that into perspective, guys, that represents a 21% jump year over year. It's just a huge leap, and it's mostly driven by stronger reference prices and higher sales volumes. But before we get ahead of ourselves, let's quickly define this metric just because it is the primary scorecard Vale uses to measure its underlying business health. So pro forma EBITDA starts with operating earnings before interest, taxes, and non-cash accounting charges, stuff like equipment wear and tear. Then it adjusts for any one-time or unusual items to show a normalized operating cash performance. Basically, it's a cleaned-up scorecard. It lets us see how the actual engine of the business is running, completely noise-free. And when we look at that scorecard, wow, it is green across the board. Net operating revenue hit $9.258 billion, which is up 14%. Our pro forma EBITDA, as we just saw, was up 21%. And net income attributable to shareholders, that reached $1.893 billion. That's a staggering 36% increase year over year. This kind of double-digit growth across all major metrics was fueled by a really powerful combination of higher sales volumes and much better realized prices across their key commodities. Section 2, the iron ore engine, navigating cost pressures. Okay, so on one hand, you have this incredible sales momentum. Iron ore sales were actually up 4% year over year, hitting 68.7 million tons. Just to give you an idea, that is the highest sales volume for a first quarter since 2018. It's heavily supported by the ramp-up of new assets and record output at specific mines like S11D. But keeping an objective view of the balance sheet here, we absolutely have to look at the cost pressures. The C1 cash cost actually increased 12% year over year to $23.60 per ton. So the crucial point for us is understanding exactly why those costs went up and how Vale handled it. The rising costs were primarily impacted by the appreciation of the Brazilian real against the US dollar, along with some inventory turnover effects. However, the market provided a pretty fantastic shield here. Realized iron ore fines prices rose 5.5% year over year to $95.80 per ton. That higher market price perfectly offset the external currency pressures, ultimately protecting their margins. Section 3, the base metals boom, a turnaround story. Now, what's really interesting about this is the sheer scale of the jump. Just look at that base metals EBITDA. It surged from $554 million in Q1 of 2025 to almost $1.2 billion in Q1 of 2026. I mean, that is an incredible 116% year-over-year increase. It literally more than doubled. So how exactly did they pull this off? Well, it was essentially a perfect storm of operational excellence meeting great market timing. Copper production hit 102.3 kilotons, which, by the way, is its best first quarter since 2017, driven largely by record outputs at their Salobo and Sossego mines. Nickel also saw some amazing double-digit growth, up 12%. Now, pair that production growth with massive price realization. Copper prices surged 48% over $13,000 a ton, and you've got a recipe for massive profits. Plus, they somehow managed to slash nickel all-in costs by nearly half. It's just wild. And this brilliantly illustrates the secret weapon in Vale's base metals portfolio. Look at the copper all-in costs, negative $642 per ton. Now, you might be wondering, how on earth can a cost be negative? Well, it's all thanks to the polymetallic advantage of Vale's copper assets. When they mine copper, they're also pulling up gold and silver. The revenues from those byproducts, especially with the higher gold prices we saw this quarter, were so strong that they completely covered the cost of mining the copper in the first place, and then some. It literally pushed the all-in cost right into negative territory. Section 4. Cash flow and debt. Translating wins to cash. That brings us to $813 million. This right here is Vale's recurring free cash flow for the quarter. It represents a massive 61% increase year over year, which is an increase of $309 million compared to last year. And this cash generation, it was driven directly by that stronger pro forma EBITDA we talked about at the very beginning of this explainer. But, if you look closely at the balance sheet, you'll actually see the expanded net debt reached $17.792 billion at quarter end. That's an increase of $2.2 billion from the previous quarter. Now, normally, rising debt might raise an eyebrow or two, but the context here is absolutely key. This increase was driven primarily for a very specific investor-friendly reason. They paid out $2.7 billion in dividends and interest on capital, which, perfectly enough, leads directly to our next pillar. Section 5. Rewarding the shareholders. Capital allocation. For those of you tracking the payouts, here is the exact timeline for that massive $2.7 billion capital allocation. If you held B3 shares on the record date of December 11, 2025, you were in the money. The first payment hit accounts on January 7, 2026 at 1.24 reais per share. The second wave came just weeks ago on March 4, combining a dividend and interest on equity for an additional 2.33 reais per share total. So it's a highly structured, very aggressive return of capital. But remember, dividends are really only one side of the coin. The board also announced a brand new share buyback program. They're targeting the acquisition of up to 120 million common shares over the next 18 months. That represents about 3% of all outstanding shares. And this isn't their first rodeo either. This new program follows the imminent expiration of their previous program, where they successfully repurchased about 34 million shares. By actively reducing the share count, they're directly concentrating the value of the remaining shares for current investors. The board was very, very clear about their intent here. This quote from their announcement pretty much says it all. The approval demonstrates management's continued confidence in Vale's business outlook, the management's discipline in capital allocation, and the commitment to creating and sharing value. Essentially, they are signaling to the market that they genuinely believe their own stock is a great investment, and they have the cash discipline to back that up. Section 6. ESG and looking forward. Sustainable operations. Let's move on and see how this builds into the future, because Vale highlighted some crucial sustainability milestones this quarter. Safety is obviously paramount, and they successfully removed 2 more dam structures from emergency levels. That means they've achieved an 80% reduction in emergency dams since 2020. On the decarbonization front, they announced the world's first ethanol-powered Guaibamax vessels, which could cut emissions by up to 90%. And crucially, they're continuing to fund and execute the Brumadinho Integral Reparation Agreement, making sure they fulfill their commitments to the affected communities. Which leaves us with this final provocative thought. We've seen record sales volumes, incredible margin protection in iron ore, a staggering 116% EBDS surge in base metals, and massive, multi-billion-dollar shareholder rewards. Vale has clearly capitalized on a robust market. But as we look ahead to the rest of the year, with their strategic projects ramping up and their aggressive capital allocation strategy in full swing, is Vale's 2026 momentum built to last? It's the multi-billion-dollar question for sure, and one I invite you to keep a close eye on as the year unfolds. Thank you so much for joining me for this explainer, and keep learning.